Good morning, everyone. Welcome to the new week. Welcome to the macro snapshot. We are Monday, September the 8th, 2025, recording this in the morning, about 7:30 or so. Okay, so let's just review and see what's going on. Obviously, we had the non-farm payrolls number on Friday, and the general consensus was that although there is some concerns that the data may be, it's complex data and it may not be entirely accurate. Nonetheless, it does seem to show a general slowdown, it seems, in the US labor market. And if we just go back briefly and review all that, we can see that the numbers, let me just put this in, the numbers came in at 22,000. And if you look at the revisions, the revisions weren't horrible, but there was still some sort of downward revisions still. And if you actually look at the non-farm payrolls 3 months average change, only 29,000. So this is indicating that the US economy at this point, at least according to this sort of set of data, and I read something over the weekend that there are substantial methodological question marks over the data. But let's just say that in general, it does look as though the US is definitely slowing down in terms of the labor market, and it now only seems to be adding about 29,000 jobs over the last 3 months per month on average. So that is definitely sort of weak. What is interesting, though, is that there's essentially zero immigration happening in the US at the moment. And this has radically sort of reduced the number of available workers and the labor force pool. And so a lot of commentators are actually saying, and I've read quite a few articles, as I say, over the last few days, essentially pointing to the fact that the US economy, just to remain stable at this point, the US labor market, I should say, it doesn't need to add that many jobs because there aren't a lot of new workers coming in. And that's specifically the sort of documented and undocumented sort of immigrants coming to the US, which essentially Trump has sealed that border. So the point is that one could argue this in two ways. One could say, oh my gosh, this is horrible. The US labor market is imploding. This is disastrous. The Fed needs to cut 50 basis points. A slightly different interpretation is that, the US labor force is not expanding because of the lack of immigration, and that actually, the US economy, if it adds 20, 30, 40,000 jobs a month, that's just fine. It's just sort of nice and stable. Interesting perspective. Nonetheless, let's just put this back here onto the 8th, which is today. But nonetheless, the market did react in a very dovish way, which is probably fairly logical. And if we actually just look and see where we're at in terms of the Fed, definitely the first cut in September here, fully priced in fact, more than priced in now, 28 basis points. So we're above the 25 basis points for a cut. And as you can see here, 1.13 cuts are priced in. Also, if you go out towards the end of the year, you can see now we've got about 70 basis points priced in. So, grinding up towards the 3 cuts. So now essentially really what the market wants to figure out is, are we getting up to 3 cuts this year? And also, is it possible that we'll get a jumbo cut of 50 basis points in September? Now, you can see here how this moved. This is the tick chart, so a very short-term chart for the December pricing. And as I just said, you can see here, this is the move, almost like a minute chart or a tick chart. You can see here on Friday morning, we were trading at about, 58, 59 basis points worth of cuts, and boom, it immediately fell down, almost into 70. At one point, it got as low as 72 basis points priced in for the rest of the year. So what's kind of interesting now is also the terminal rate. We're now at a terminal rate which is almost down to about 3 or so. So where are we? So yeah, you can see here the implied rate, and you can see here that actually in terms of the Fed funds futures, we are actually the terminal rate has gone down, and it's now at about 2.8% or so. So from where we are now at 4.33 effective Fed funds rate, going down to 2.8, that does imply about 150 basis points worth of cuts over the next let's call it sort of 18 months or so. So definitely a dovish repricing has occurred because of that data. And what's also interesting to look at is just the reaction of I've got here the inflation swaps, which of course is how the market sort of prices expected inflation. So it's not a CPI number or a PPI number. It's really a market-based sort of interpretation of where inflation's going. And what you can see here is that we've got all the different tenors. So if you look at the 1 year, you can see that it's come down. You see how it's come down quite a lot. And then if we go at the 2 year in the blue, that's also come down. And then we have the 3 year and all the way out. So you can see all the way out, but especially for the 1 year and the 2 year and the 3 year, inflation expectations, inflation swaps here have been priced downwards. So quite significantly, they were up at about 3.46, now at about 3.3 or so. So quite a significant sort of pricing, dovish pricing there. And what that's telling you, the market is basically saying that the interpretation is it seems to be a tipping point saying that this data, which is the labor market data, will cause the Fed to cut definitely 25 basis points in September and maybe even 50. And we'll start some kind of cutting cycle, maybe, 4, 5, 6, 7 cuts over the next 12 to 18 months. And what it's saying is that, yes, are there concerns about inflation? Now, of course, we do have the inflation numbers this week. But what this inflation swaps is telling us, and also if we look at something like the yield curves, let's actually start looking at some of these yields. What's actually quite interesting is that after the data, we saw that yields actually fell. Now, that's not so surprising at the front end of the curve, because if we look at the front end of the curve, which I will scroll down to, so let's look at the 2 year, you can see here that clearly on Friday, the yields fell quite a lot here at about 3.58 down to a low of about 3.48 or so. So definitely the yields on the front end of the curve falling. But really what the narrative has been over the last week or two is this sort of steepener narrative, essentially saying that, oh, the Fed is cutting into a strong economy. Therefore, okay, the front end yields might come down a little bit, but that means they'll be less focused on inflation. The economy is still going to be running hot, and therefore, because of inflation being sticky and continuous deficit spending and then the economy going well, therefore long-term yields must rise comparatively, and that would cause a steepening of the curve. But what's actually quite interesting is that after the non-farm payrolls last Friday, okay, the 2 year came down, the 5 year came down, but also if you look at the 10 year, that's actually come down a lot as well, and the 30 year has come down a lot. And if you actually look at the curves, we can look at a few different curves here. Even like something like the 2s to the 5s didn't go up too much, but if you look at, let's say, 2s, 10s, you can see that basically it flattened a little bit. If we look at the 2s, 30s, you also see it had a bit of a crazy tick that also sort of flattened a little bit or remained flattish. And the 530s also has not really steepened that much. Initial jerk upwards, but then it's sort of almost like a flattening formation. And that's quite interesting because that's the market sort of communicating to us that we traders that actually, they are worried about a generalized economic slowdown. So the point I'm trying to make is that there's a nuance between, oh, the labor market softening a bit, but the general economy is strong. But what this sort of slight flattening or sort of neutral yield curve seems to be telling us, and the inflation swaps as well, is that the market is starting to price in some concern that this slowdown in the labor market may lead to a more generalized sort of slowdown in the broad economy. And that could cause prices to actually sort of deflate a little bit because that would indicate less demand and therefore inflation essentially wouldn't be such an issue. What does that mean? That means maybe a flatter yield curve. So yields can come down not only at the front of the curve, but also in the belly and the long end of the curve. All of this, of course, is a little bit of a negative for the US dollar. And just while we're looking at the data, we can also just have a look and look at Canada, because Canada, is just north of the border and of course is tied up very much with the US trade situation. So I'm going to put up here just the data from Canada last Friday, which was fairly unpleasant. And if we actually look at it, right, we have to go back. So we'll go back to Friday the 5th. And if we actually just look at the employment data we got in Canada, it was pretty horrible as well. Negative 65,000, so a net loss of jobs. Survey was for a small gain. Now, if you put on that, the prior was minus 40. Now we have suddenly minus 65. The unemployment rate went up from 6.9 to 7.1. So think about it. In the US, 4.3 unemployment rate went up, but in Canada, also 7.1, so significantly worse. Participation rate, okay. But then you actually look at the employment change, so losing full-time and also part-time jobs. So the point is also in Canada, which of course is intrinsically linked to the US situation, and obviously there are sort of a lot of concerns around the tariff situation. It looks as though Canada is starting to have some sort of generalized weakness. And let's not forget that in Canada, most people are very heavily indebted in terms of their mortgages. And as a percentage of sort of income, disposable income, the mortgage is amongst the highest in the world. And so the point is that there's a lot more floating rates in Canada to compare to something like the US, where there are a lot more fixed mortgages. So this could the point I'm trying to make here is that this could lead to a little bit of sort of nastiness coming into the Canadian economy, and therefore would have to start looking out a little bit at maybe things like sort of Canadian bonds, Canadian banks, CIBC, this kind of thing here. But also, let's have a look at the Canadian dollar, which, although against the US is not, is holding up relatively well because the US dollar itself is weak. But on some of these cross pairs, could be interesting to look at that. And you see here that the US dollar, again, it's come off its highs against Canada, but it's certainly not collapsing as it is, well, it's not weakening as much as against other currencies. And if we look at something like Euro CAD here, you can see here that Euro CAD and some of these cross pairs, the CAD is really under quite a lot of pressure. Okay, so let's just look at a couple of other things happening this week. Excuse me, just want to grab some tea. Tea for two and two for tea. All right. So obviously, the important thing, we have the inflation numbers coming up. Now, what is unusual is that we have PPI preceding a CPI. PPI is normally a fairly accurate sort of indicator of what's going to happen in CPI. So let's keep an eye out on that. That's happening on the 10th. So that's happening on Wednesday. And then we have the CPI on the following day on Thursday. So that's unusual to have them mixed in around about that. And as you can see here for the CPI, you can see here that year over year number 3.1. It almost feels as though the market has given up and sort of said, okay, the Fed's not really worried about trying to get down to 2% inflation, and that, something 2.5, 2.7, 2.8 will be fine. And anyway, with the labor market weakening and potentially the real economy weakening a little bit, we're not really going to worry about inflation. So the point is that, will this CPI, no matter what happens, will that be enough if it's hot to derail the Fed cutting in September? It's an interesting one to see, but most market commentators are saying that probably not, unless it is a very, very, very hot number. What would that be? Maybe 0.5, 0.6 or something. But even then, it's doubtful that the Fed will not cut. So that's probably the main bit of sort of economic data we get. We get the initial jobless claims. It's going to be interesting on the back of the employment data we had last Friday, just to see if the continuing claims and the initial jobless claims, if they confirm any kind of weakness in the US labor market. In terms of other stuff, quite interesting what's happening today. We have in France, we have the confidence vote, which probably will remove the centrist government of Prime Minister Bayrou. Keep in mind, if we just look at the sort of the OAT, so the French bonds, a lot of that's been priced in. The French government is expected to fall. Really, what's going to be interesting, Macron, the president, has a few different choices here. If the government falls and the opposition left-wing party and the right-wing party don't support him, which seems to be very low probability, you can see here that the OAT, so the French bonds, they actually have kind of bounced off this triple bottom here, and they've had a little bit of a comeback. So most of this uncertainty is priced in. So really, the question now is what happens next. Macron can either dissolve parliament completely and can call new elections, which he probably won't do, because that's going to cause a lot of political uncertainty. Probably that's what the market wants the least. Otherwise, he can appoint some kind of technocratic, temporary sort of prime minister, or he can try and cobble together some kind of coalition of the willing and see what happens. So there could be some uncertainty here. Let's just see the fallout of today. But as I say, a lot of this has already been priced in. I think if Macron were to call an election, that could be not received very positively by the sort of the French bond market here. And if we actually just look at the spreads between France and Germany, they have come off a little bit off their highs, but I think it is possible that they just, especially if elections are called, that spread goes up in favor of France again. Well, actually, it's kind of a negative thing in a certain sense, but the spread would actually increase, maybe back up to this level here, about 81, 82, 83 basis basis points. I think that's definitely possible from its current 76. So that's something to be looking out for there. Keep in mind as well that this Friday, so in 5 days' time, the ratings agency Fitch also gives an update to its rating on France, on sovereign debt out of France, expected quite possibly to downgrade. So that could also be a catalyst for another bit of sort of negativity in terms of the French bond market. Now, the question is, will that spill over into the euro? Maybe, maybe not. If we look at the euro, you can see here that the euro against the US dollar, it's interesting. The euro hasn't really ripped enormously, considering the soft employment numbers we got last Friday in the US. So maybe some of that political uncertainty in France is just keeping a bit of a cap on the euro at this point. And were the situation in France to stabilize, who knows? Possibly the euro could push up a bit higher against the US dollar. Maybe it's just trying to get through today and just see what happens. And if that sort of passes, relatively as expected and in an orderly fashion, maybe the euro has a bit more upside. And keep in mind that a lot of this is already priced in. And what I would also say is, keep like a bigger picture thing is that remember the European Central Bank, whether you agree with it or not, they did establish this transmission protection instrument, TPI, transmission protection instrument, about a year ago, actually maybe even more like 2 years ago, which essentially is sort of a fake way of capping European sort of bond spreads and making sure that the peripheral spreads or no spreads blow out too much. And essentially, what would happen is that if the situation in France deteriorates too much, the European Central Bank would undoubtedly, presumably, buy a boatload of French OAT bonds just to sort of cap the yields. So the point is that there are some mechanisms in Europe just to prevent or to contain any sort of political spillover, any negativity from the situation in France. So my point being that maybe the euro, the political risk, it's sort of already baked in, and probably a better way to express that is actually euro Swiss franc. And as we can see here, the euro Swiss franc, has actually been under a little bit of pressure in the last couple of weeks. So my personal view is that quite possibly that is, reflective of a little bit of political uncertainty in France. Is that softness here against the Swiss franc, the euro Swiss franc is a better way to express that. Often, of course, the spreads is the best way to express all of these things. Okay. Also, just want to have a look at the situation talking about currencies in Japan. We had the Japanese Prime Minister Ishiba essentially over the weekend indicating that he would resign. And now on October the 1st, there's going to be an election, a leadership election for the Liberal Democratic Party, which of course is the main party in Japan. Now that's going to create a little bit of political uncertainty. There are two main candidates. One's a little bit more fiscally conservative. One is a bit more of a populist. And also the thing is that just this uncertainty leading up to October the 1st, that could just prevent the Bank of Japan, if they did want to or had been thinking about sort of normalizing, and let's just look at the USD versus JPY here. If they wanted to increase their interest rates, hike their interest rates, and normalize, because inflation does still seem to be sort of a little bit sticky in Japan, the political uncertainty will probably prevent them from hiking anytime soon. Knowing the Bank of Japan and their history, they will want for the new prime minister to be in place, for the political situation to be relatively calm. So that could create it could mean that the BOJ holds off for a little bit and could create just a little bit of uncertainty. There's also some talk that with the LDP suffering a couple of poor election results, that some of the opposition parties, which are much more populist in outlook than the Liberal Democrats over in Japan, they have slightly more expansionary fiscal policies, and that could cause ultimately sort of a run up in the yields, especially in the longer term bonds, the 10 years and the 30 years. And we know that the Japanese bond market is one of the major bond markets in the world. So presumably there would be a bit of contagion, and that could push, potentially a bit of upward pressure. It could put a little bit of upward pressure on other bond yields. For example, the German bonds or even in the US bond yields. So that's something to keep an eye on. Is just that situation over in Japan. I also just want to look at the oil situation here. OPEC Plus over the weekend, sort of as expected, or as the rumors had told us, they did hike their output, but it was relatively modest and kind of expected by the market. The final number here is 137,000 barrels per day, which is quite small. It's probably more of a symbolic thing to say to the rest of the world and the non-compliant OPEC members. Hey, when I'm talking about Saudi Arabia, is essentially saying, hey, we're prepared maybe to take a bit of pain with the price. We're going to grab a market share and we're going to pump our full quota. So gradually, OPEC Plus is increasing its output. But they said in the press conference and well, sort of the statement that the reason, they're pretty confident that there's steady global outlook, in terms of economic outlook. So OPEC Plus judges that the global outlook is, as in their words, steady, and also that there was a healthy market fundamentals. And it is true that if you look at global inventories in OECD countries, so economically advanced countries, global inventories of crude oil are relatively low on a sort of historical average basis. So it's interesting here, and you see the reaction that oil it dipped just for a few minutes at the open last night, but basically it's having a little bit of a comeback. Again, I personally don't see any particular reason here for oil to rip. On the other hand, it probably is going to be comfortable just in this trading range. If we look at some of these moving averages here, you see it's still, still trading a little on the heavy side. It is below all the moving averages, but it wouldn't surprise me if this level down here, let's call it about 61.50 on the WTI, if that does become some kind of sort of base around there, maybe down to $60 or so, and oil just essentially meanders around in this trading range for the next period, just awaiting new information about the global economy, tariffs in China, et cetera, et cetera. Okay, guys, I think I'll leave it there. Just one final thing. Let's have a look at volatility. You see that here there was a bit of a volatility crush. Volatility collapsed after the non-farm payrolls. And interesting to look at what happens with stocks here, because stocks, they initially rallied, but as a lot of market commentators were saying before, they could, on sort of a weakish number, they could sort of pop and then maybe sort of come off a little bit. And it does look as though stocks are not loving the weak data. So if you look here at the S&P 500, if you look at Nasdaq, a little stronger. If we look at the Russell, which is obviously a bit more the smaller caps, I mean, not bad. So they're moving up a little bit, but it's going to be quite interesting. Really, whether to figure out whether this sort of weak data is a cause for celebration. It's like, oh, fantastic, the Fed will definitely be cutting, 3, 4, 5, 6 times over the next 18 months, or whether more to what the bond market is saying, that this weak data actually does forecast or presage sort of a general weakness in the economy, which potentially at some point could weaken the stocks. On the other hand, if we do have a bit of sticky inflation, sort of assets, US dollar denominated assets like stocks, tend to do quite well as long as the inflation's not out of control. So it's going to be an interesting one to see. Let's see how it trades today. And I think that's about it for today. Okay, have a great day, have a great week, and we'll keep this going tomorrow. Thank you.